I'm Ryan Green, advisor Brand Asset Management Group. I am joining Cliff Aqui today, our investment analyst, and we want to thank each of you for taking some time out of your day to join us as we talk about the role of alternatives in client portfolios. Now, as always, before we get going, we do have just a couple quick housekeeping items for you. The first of which is, Cliff, you want to go to the next slide? We'll give everybody a chance to review our disclosures. I'm sure everybody will thoroughly read these. These are very important. We must insist that you read through this and be fully up to speed on our disclosures. And while you're doing that, I would also like to point out that as we move along today, we've got a very, very wide-ranging topic. We'll be talking more about this as we go, but we're going to touch a lot of different areas at a very high level. We probably have to have multiple days of 8-hour webinars to really tell you everything there is to know about alternatives. So we're going to try today to give you a really good high-level overview of what they are and how we use them. But we might imagine that you may have some questions as we go along today. So as always, we'll try to save a little bit of time towards the end of the discussion to try to do our best to answer those questions. So if you do have a question, you should see a little Q&A box down towards the bottom of your screen. Please feel free to go ahead and type that question in there. And like I said, we'll do our best job to try to answer that. With that good stuff out of the way, let's go ahead and jump right into it here by trying to answer what I would say is by far the most common question we get when we start talking about alternatives. And that is, what are alternatives? And I don't even know what that means. Tell me what that is. And if you've ever asked that question of us in the past, you've probably got an answer that sounds a whole lot like, well, we can tell you what it isn't, because that's probably the best way for you to understand. And we've probably said something like, it isn't publicly traded stock or publicly traded bonds or cash. It's basically any other kind of investment besides those things. And the reason, you've gotten that answer with probably a little bit of a smile is because that really is succinctly the best way to answer that question, because alternatives are just so varied. There's so many different types that do so many different things. They really can be just about anything. Think of timberland or an art collection or a wine collection or derivatives or commodities or coins or currencies. And that's only just a tiny fraction of what they could be. So in some ways, it is easier to simply understand what they aren't. But I like to think about it in terms of what do we want them to do? Why are we using them? Specific to your portfolio, why do we think the use of alternatives is important and beneficial to your structure? And that's really what we're going to talk about today. But I'll give you just a little bit of a replay the tape type thing here. I started my professional career with Brand Asset Management Group in the fall of 2007, which was, I'm not kidding, literally right before the financial crisis started. Didn't know it. This was October of 2007. Didn't know it at the time, but the markets would reach their peak very soon after that. And what followed, for today's purposes, I'm not going to give you that history lesson, but what followed was a period where public markets really struggled. And that's relevant to today's conversation because it really fueled some end investor desire to have an investment in a portfolio that didn't move the same way as public markets do, that could do different things in periods of extreme volatility. And that's really where we started to fold alternatives into client portfolios, at least in the current iteration. Alternatives have been around for a very, very long time. I mean, gold's been an investment for literally thousands and thousands and thousands of years. But really following the financial crisis was when retail investors, end investors, i.e. not institutions, endowments, pension funds, really started to drive up a lot of demand for something they could add to their own investment portfolio that would give it kind of a third investment variety that would behave differently, a little bit differently than public markets. So that's just a little bit about what they are. So why do we want to include them? Now, I just mentioned that investors had this desire to have something that performed differently, but why? What does that really mean for the bottom line? And so just like alternatives themselves are extremely varied in their nature, can do all kinds of different things, different strategies, so too are the reasons why an investor may want them as part of their portfolio. Most commonly, those would be things like enhanced return, enhanced income production, better diversification, which can lead to lower correlation and lower volatility in the portfolio, But also you'll see some people just want to have more things to choose from. They just like the idea of having more wide ranging choices when it comes to the creation of their portfolio. But ultimately, at the end of the day, what our purpose is to try to produce the best return that we can for a given level of acceptable risk. And this is a good way to kind of start to show you what a little bit about what that looks like. And to give you that illustration, we got to go back in time again, this time a bit further. We're going to go back to 1952, when economist named Harry Markowitz developed what would become known as the efficient frontier. The efficient frontier shows you optimally constructed portfolios that produce the best return for a given level of risk, or for a given level of return, the least amount of volatility. And if we look at just a very simple two asset class line, you get the darker blue line that's a little bit over on the right-hand side there, which shows the relationship in risk and return for different levels of stock exposure and bond exposure. So looking over on the very right-hand side, you'll see a portfolio that's been constructed with all stock, has the highest expected return, but it also has the highest level of expected volatility. So traditionally what investors do is begin to add bonds into that portfolio, which then moves you in a left-hand direction down that line. You do give up some expected return, but you also take some significant volatility out of the equation. But the point of this line is that at any given point on it, if the portfolio has been optimally constructed, it's going to give you on that line the best return for the level of risk that you're willing to take. Alternatives change that a little bit. If we add in a new asset variety, in this case, public equity, represented by the alternatives percentages of 20% that you see there, as we begin to add that in, you actually shift the entire line up and to the left, which is exactly what we're shooting for, right? We want to get more return for that same level of risk, or for that same return. If we can do that with a little bit less risk, that's going to be very much of interest to us. So shifting that line is really one of the key benefits of adding those alternatives to the portfolio. So how does that really happen though? How does that really get produced? How can you tell me you could give me a better return for the same level of risk? And there's really two main things going on here for us to understand. The first relates to correlation coefficients, which is really just kind of a fancy way of describing how two different things move together. Do they move exactly the same? Do they move in opposite directions? And the correlation coefficients help us understand that by giving you a range of between 1 and -1. So every couple assets that we look at are going to fall somewhere in that range of 1 to -1. If they're 1, if they have perfect correlations of 1, it means they move in exactly the same direction. So if investment A is up 10%, investment B should be up 10%. And you can see where that still gives you a good level of expected return, but you've done nothing for risk control by having two perfectly correlated securities added together. Conversely, if you've got -1 correlation coefficient, that means that those two investments are perfectly negatively correlated, which they move in exactly opposite directions. Investment A is up 10%, investment B is going to be down 10%. If you add those two together, you've got a return of 0. Let's say the next year, those same investments have a return of 5. Investment B is going to have a return of -5. The third year, you've got A is up 8%, B is down 8%. Your return is 0 in every single year. So your risk is non-existent. Your volatility is 0. There isn't it. It's 0 every single year. But you've also created absolutely no return for yourself, which hasn't really done you any favors as far as trying to grow your investment portfolio. So we're looking for things that have low correlations. And if you look here at the graphic, you can see that the S&P 500 or stocks compared to the Bloomberg US Aggregate Bond Index or bonds, the two of those have a correlation coefficient of 0.26. So fairly relatively low correlated, which is why historically bonds have been a very popular way to mitigate the volatility inherent with stocks. The old stock to bond portfolio has been around for a very, very long time, and this is one of the main reasons why. But that's not the end of the story. There are many different investment types, many alternatives that you can see outlined here, and less important what they actually are, and more important is some of them have low correlations represented by the blue boxes. and not just low correlation to stocks. They can have low correlation to bonds and low correlation to each other. So by adding in alternatives, especially a variety of alternatives, you can really get a lot of different things in a portfolio moving differently at different times, which does serve to reduce the overall volatility of the portfolio at large. So that's kind of one reason that enables us, or one way that we can reduce that volatility. Then on the next slide, what you'll see is kind of the return enhancement part of it that we mentioned before. So we're going to draw a few comparisons here. You can see this is just an array of different asset types, the risk and return parameters for each of them over the last 10 years, ending with the third quarter of 2022. And let's focus again on a few comparisons here. So the first of which would be the S&P 500, or again, stocks, compared to what we're calling here PitchBook PE All Global, which would just be a measure of global private equity. So you've got publicly traded stocks and private stocks. And you can see that over that 10-year time frame, the private equity had a higher return. It also had lower level of volatility. Let's do another comparison. If we look at the measure of publicly traded REITs down here and compare that to privately traded REITs, which are represented by the red triangle there, you can see that once again, the privately traded REITs had lower volatility and a higher return over that 10-year time frame. One last comparison here would be the Bloomberg US Aggregate Bond Index, bonds as we saw before, compared to private debt, which is that green outline, the triangle. You can see that even though the private debt did have a little bit more volatility, it had significantly better return over that 10-year time frame. So you've got specific examples here of how individual alternative types can have better returns while also exhibiting lower volatility. And if you combine that with that lack of correlation or low correlation that we talked about before, that really is what gives you that ability to produce an outcome that results in a portfolio having potentially better returns with potentially less risk. That's why we find the use of alternatives so compelling. So with that initial kind of salvo out of the way, I'll go ahead and turn it over to Cliff to talk a little bit about specific types of alternatives and how we use them.
Yeah, thanks, Ryan. And with that, just these broad asset classes, these indexes that we included here from PitchBook include such a wide variety of different funds, because it's really all the funds that PitchBook tracks. And so we'll try to break it down into 4 distinct categories for you today: real assets, hedge funds, private credit, and private equity. And there's different reasons to use them. We have them listed here. For real assets, it's both income and inflation protection. Hedge funds really is more diversification. As you can see on the chart, I'll flip back one last time. These hedge funds, they're kind of in this area here. If we included more groups, it would get even more crowded. There's different types of hedge funds. They all tend to be in this area of this risk return chart, but they definitely have lower correlations, as we can see in this chart here. So different reasons to use different types of those hedge funds. Private credit could give us more income, but also be a return enhancer potentially. And then private equity, as you saw in the last chart, it's really potential for higher returns, potential for lowering volatility. There's a wide dispersion within private equity managers, so you definitely want to make sure you're working with the best managers you can find, because there's just such a wide range versus the public markets where you see managers kind of perform similarly to each other. In the private markets, they really can vary pretty widely. In the next chart is from Preqin, which is a big alternative investment or research firm. They polled institutional investors' reasons for using alternatives, and so this kind of breaks down into the real assets one for us. But you can see the main reason most institutions use alternatives is for that diversification. I'd say the reducing volatility, lower correlation, those are tied together to this diversification aspect, but also they're looking for returns. And then again, this is an income stream and potentially an inflation hedge as well. So there's definitely different reasons to use them, but mainly, as Ryan said, diversification, shifting that efficient frontier over to the left and higher is the ultimate goal. So that is the basic intro. I'll start with our first asset class of real assets and kind of give you some flavor into that. And real assets are really physical things that you can own. You're probably never going to own commodities that we have listed here, but you can own real estate, you can own infrastructure, and they're different from financial assets, right? Which you can see on paper. you could have a stock certificate, I guess, but you don't really own anything physically. You own, either a claim on their income stream, or a claim for them to pay you back debt if you lend money to them. So there's nothing physical that you can touch. Whereas with real estate infrastructure, there actually is. Again, commodities, they're usually done on a futures basis. I don't know if there's a sort of funny story in the paper yesterday, the day before, about JP Morgan writing futures contracts on nickel, and someone in the warehouse discovered that the bags of nickel that they were writing contracts on actually had rocks in it. So they had lost a few $1 million of their nickel that they never actually really had. But so I'll lump real estate and infrastructure kind of together, because while they're owning different things, with real estate, you're owning multifamily apartments, office, industrial, or retail. Probably less office and retail today, but the dynamics for multifamily and industrial are really strong still. In infrastructure, you're doing things like energy infrastructure, transportation, utilities, things like that. But the reason investors like those things is because they generally provide stable income. There's long-term leases with infrastructure. A lot of times there's tolls or utilities have built-in escalators tied to inflation. So you really are getting stable income and some inflation protection based on just prices going up, and you can raise rents. And infrastructure has these contracts tied to inflation. So you really have some income, have some inflation protection. It's a big spectrum in the universities, you might imagine. So as I talked about, different managers having different return profiles, there's different types of funds you could invest in, starting at core, which would be your buildings that are fully leased, projects that are developed. You can see the cash flows, you know what you're going to get. Since you know what you're getting, your return and risk should be lower. And that spectrum goes out to core plus, where maybe you're taking on a little bit of lease up risk, where you need to rent out a building, to value add, where you're taking over an older building and you're redoing it and then trying to release it, to opportunistic, where maybe you're doing some development, building a new building, building a power plant, something in the infrastructure space. So a wide range of risk and return available within the real asset space. The way we've done it at Brand thus far is we've used the Principal Diversified Real Asset Fund, which invests in more publicly listed real estate, global infrastructure, commodities, which tends to be a little more volatile, as you saw in that risk return chart that Ryan touched on. But this has given us a really diversified approach to accessing this space, which, as you can see, it has a lot of different opportunities to invest in. So with that, I'll turn over to Ryan to talk about the hedge fund space.
Yeah, thank you, Cliff. So hedge funds. Hedge funds, one of those terms that I think most people have heard of, but if asked, they may not know exactly what that actually means. And I think part of the confusion is hedge funds really can be a lot of different things. Kind of like that's one of the themes that you've probably heard several times already with alternatives, is there's really a lot of variation in strategies and what these things are designed to do. But originally, they're called hedge funds because of literally a line of bushes, a hedge set up as a perimeter or a guard area around a property. And they were originally used to do that, to try to provide a hedge against risk in an investment, something that could give you returns, but also eliminating some risk, which again is somewhat thematic to what we're talking about here today. And so while they could be many, many different things with many different strategies, some of which you can see here, I thought we'd spend a little time today talking about, specifically within our client portfolios, how are we using something that falls under that broad category of hedge funds. And the first of which would be an example of an event-driven investment that we've been using for a while now, called the Merger Fund. And what the Merger Fund does is it attempts to find investment opportunity that's created by a specific corporate event. Think a merger or an acquisition. And what Merger Fund's interested in doing is understanding the dynamic involved in that action. Who stands to win? Who stands to lose? We're less concerned with what the market's doing at large. We're only interested in how these two companies are likely to move in relation to each other as the deal is announced, goes through various hurdles, hopefully gets approval, and then ends up getting consummated. They're looking for the winner and potentially the loser in that arrangement, and by doing so, they can create a return But since they're less concerned with how the markets at large are behaving, the potential to make money may not be driven as much by markets as literally maybe just owning one of those underlying companies might be. So that's a good example of event driven, which is a type of hedge fund. Another one is one that many of you might be familiar with, as it was really one of the original alternative strategies that we began to use in client portfolios, called multi-manager, multi-strategy, which is a little bit of a mouthful. And what does that really mean? What that really means is there's two components. There's the multi-strategy and the multi-manager. And a good way to understand that is to think about another one of the funds that we've used for years now called the John Hancock Alternative Asset Fund. And we can first talk about the multi-strategy aspect of that fund. So the management team at the Hancock Fund has an objective. And that objective is to produce a relatively steady return stream with very low volatility and very low correlation to public markets, kind of that traditional role of alternatives in portfolios, at least as it relates to the volatility control slice of that. And how they do that is fairly interesting. So they've got a number of different opportunities at their disposal. You can see here, they're arranged kind of graphically, all the different underlying alternative investments that they can use as part of this fund. And it changes through time. Right. And that makes sense because at any given point in time, the world around us looks different. There's different opportunities available. There's different trends emerging. There's different things that they see might happening. So they're going to be all over the place as it relates to how they allocate some of these, some of them being a little bit more consistent over the years. You can see infrastructure managed futures. Those have remained relatively consistent. But look at the bright orange down there. Short duration credit used to be a fairly large piece. It's now non-existent in the portfolio. Hedge activity has grown a bit over time. So this gives you an example of how these different underlying strategies can be used and how they might change throughout time. Again, trying to produce the deliverable, the outcome. That's what's important to focus on here. That's the multi-strategy component of this. The multi-manager component comes into play because if you look at each of these different investment types, Hancock has the ability to select fund managers or investment managers within each of these areas to get diversification of thought, but more notably specialization in each of these areas, which is designed to provide best of breed in fund operations instead of the management team at Hancock trying to not only determine where is the opportunity, but then to be able to take advantage of that opportunity, they've kind of subbed that out to the various managers that really specialize and have a really good track record in that space. So that just gives you an idea how that multi-strategy, multi-manager approach might work, which is classified as a hedge fund type strategy. We go to the next slide. We'll talk a little bit about private credit. So private credit is, again, I'm going to keep coming back and keep saying this, private credit is another one of those things that can mean a lot of different things because there's a lot of different flavors. But the long and the short of it is there's a lot of loan and lending activity that takes place outside of public markets. Most people are going to think about government bonds. You got my treasuries or my mortgage-backed securities or anything that's over on the government side, or corporate bonds. GM's going to issue a bond and I'm going to be a lender to GM and buy that bond. That's what most people think of, and that does make up a very large portion of the debt markets, but it's certainly not all there is to it. There's a lot of investment opportunity outside of those public markets, and these are just several different examples of that. Once again, we thought it would be beneficial to share a little bit about how we use private credit in client portfolios through the use of a specific fund. But before we do that, this really illustrates the magnitude of what it is that we're talking about, that as of the end of 2021, there was $1.4 trillion in private credit markets, again, representing a very meaningful slice of the overall debt markets. And a lot of good investment opportunity comes along with that we don't want to ignore. We want to be able to access. Specifically, we've been doing that through a fund called the Stone Ridge Alternative Lending Fund, which is really focused on consumer debt. This graphic really helps put that into perspective. So we've got our government debt, the biggest piece of the pie, at 11.1 trillion. Also investment grade corporate debt, that's those GM bonds, for example, I was talking about. Asset-backed securities, another big piece. But again, that's not all there is to it. consumer debt at 2.9 trillion does represent a fairly meaningful investment opportunity. To a lesser extent, small business also represents a little bit there too. And that's really where that Stone Ridge Fund comes into play. That's really their specialty, is to provide access to that consumer debt, which provides a different way of producing investment returns from the debt markets that aren't government bonds, that aren't corporate bonds, that aren't municipal bonds. This is just a different way. And it's probably a deeper dive for a different time, but the way that that fund does it is pretty interesting in how they've constructed their loan portfolios and really what they're looking for in terms of providing that. But the outcome, the old what's in it for me type answer is you can get better returns that are less volatility than what's available in public markets. That same thing we keep coming back to here, and that's represented by the graphic here. That in municipal bond space, you've got kind of two components to that overall return. You've got kind of the risk-free return and then the risk premium. The risk premium comes into play because if investors are going to take levels of risk, they must be compensated by additional return, or there's no incentive or motivation for them to do it. If I don't get paid anymore for taking more risk, why in the world would I do that? But different investments have different bang for the buck, as it were. In some cases, you get more of a risk premium, in some cases, even for the same level of risk, which again is where some of these private debt instruments come into play. And it can be meaningful too. I mean, you can see here as represented, I mean, the risk premium can be significantly larger in these types of investments. That's why we find it very interesting to think about how and to what extent these are added into client portfolios. At this point, I'll let Cliff talk a little bit more about private markets, in this case, the private equity side of things.
Yeah, and I'd add one thing to that, Ryan, on the private credit side is this duration number down here, which speaks to your risk of rates rising. So Stone Ridge, that fund did write down their portfolio over as rates rose, but on the other side, they're writing new loans at higher rates. So the fund was up low single digits last year in a market where obviously fixed income was down, and yeah, I think that they're very happy with the way that fund is performing and had performed. I'll turn to private equity now and highlight some of the differences between public versus private. So obviously you have a stock portfolio, you can buy and sell stocks daily. There's a lot of information out in the market and financial statements that are available to all investors. Most managers are passively investing, right? They're buying a stock because they think it'll go up. They're not being activists for the most part, trying to evict any or make any changes at the company. The difference in private equity is a lot of funds actually do try to improve companies, make them better, own them as an operator. And the non-transparency actually helps them because they're getting in and seeing private financials that the public markets can't see. And they can kind of structure deals the way that they want to structure them for the best outcome for themselves and the end investors. One drawback is there usually are higher fees, and again, those performance fees called incentive fees for a reason. One of them is to incentivize the managers to do a good job for you at the end of the day. So that's the main difference between private and public equity. And again, there's another liquidity spectrum here, risk spectrum. When you come to think about from the public side, where you can buy and sell daily, all the way out to venture capital, where your money's getting locked up for a number of years, up to 10 or even more in some cases, as we want to give the private equity funds, the managers of those funds, time to really invest in the company, work through it, and bring it to the best possible outcome at the end. There is, you do give up that liquidity for that hopefully potential return that will come at the end. Just highlighting the different types of private equity. Primary private equity really is when you're investing directly into a fund. You don't have a lot of visibility. It's usually they haven't done any investments or they've only done a few. So you're trusting that manager that they're going to do what you expect them to do or have done in the past. Secondary is a way to buy a primary investment from another investor that's looking to get out of it. We've seen a lot of that this year as a lot of institutions had their public market portfolios decline, but their private market portfolios went up. And so now they're out of balance with their investment policy statements. So they're actually going to the market and selling some of their holdings in private equity at a discount. So that's an opportunity that's in the market today. Co-investments, where you actually don't invest in a fund, but you invest directly into a company with a private equity manager. So the private equity manager may want to buy a company, but it's too big of an investment for a fund that they have. They don't want to make it that big of a part of the fund because it would expose too much risk or just put them out of line with what they said they were going to do. So they'll sometimes go to their investors and offer a co-investment to invest alongside them with no fee, sometimes in most cases. So it's a nice way to get private equity exposure, but not pay those large fees. And then the three at the bottom here are kind of your different flavors. Buyout's kind of what most people think of when they hear private equity, where you're sometimes taking leverage to buy a company out. So those are some of those bigger funds that you see or hear of in the market. Growth equity is when a company is past the startup stage. It's a viable company, but maybe they need to make an acquisition or they need capital to grow their business and become bigger. So that's when they'll go looking for some growth private equity. And then finally, venture capital, which is the Silicon Valley type stuff that early stage companies that are looking for funding to grow those businesses to keep them going. Maybe early, too early to have revenue, but they still need some capital to get off the blocks. Why private equity? It's a large opportunity set. This one shows the 4,200 companies that are listed in the United States versus the number of private companies that employ over 100 people. We had another chart in here, but it's about revenue. So 74% of companies that have over $100 million in revenue are private. So only 26% are public. So there is a huge amount of opportunity that we don't see in the public markets every day. Here's just a chart illustrating how drastically the number of public companies has declined over the last 20 years or so. And the reasons for this is because companies are staying private longer. They don't need to go to the public markets. They don't necessarily want to do an IPO and have to file statements. And it's sometimes it's just truly a headache to answer to the end investors. And there's so much capital in the private equity markets that they can access those markets and have just kind of stay private until they're profitable or until there's a reason to actually go public. I was on a call with Private Shares yesterday. Private Shares is a late stage VC, so they're investing in venture capital companies that are kind of on their third, fourth, fifth round of investing, usually closer to going to an IPO through 2 to 4 years out. And it's fascinating. So probably all have heard the term unicorn, which is a private company that has over $1 billion valuation. Well, back in 2013, there were only 13 unicorns. And so fast forward 10 years, now there's over 1,200 unicorns. So that market has really, I think they either need to change the definition of a unicorn or change the name, because there's a lot of private companies worth a lot of money out there in the markets today. So this is just another way to look at the performance that we showed on the earlier slide. This ends last year. The other slide was up to date through September, but these numbers would be even more drastic after performance last year in terms of the public markets being down and private markets. I assume that index will have a positive return when it comes out, but private equity really has outperformed over time and done so with less risk, which we can see here on this chart. I'll just wrap it up with some thoughts, and we'll take some Q&A here. But benefits of alternatives, as Ryan so well in the beginning, complements your traditional portfolio of stocks and bonds. They diversify and the potential to enhance both return and reduce volatility. So those are the benefits. But we have to talk about the considerations here. There's less transparency, which, as I mentioned, in private equity can be a good thing because they don't have to report to the public. They can make better terms when they go to buy companies. So it's not necessarily a bad thing, but it's just something to know going in. And of course, less liquidity. There can be lockup periods, as I mentioned, as they want to work through with their companies and have time and not be forced to make any drastic changes just based on the markets. Higher fees, as we mentioned, but again, want to incentivize those managers to do well. There can be leverage, which can enhance returns, but also can enhance risk if rates rise, or as we've seen, or they struggle or have some issues where they need to sell things. So leverage is a consideration, and then concentration risk. Some funds can own just a handful of assets, whereas a mutual fund that holds 100+ stocks is very diversified. Some private equity funds may only hold 10 to 20 companies. So something to be aware of there as well. So I think I probably went through it too fast, Ryan, because we're still plenty of time, but let's open it up to Q&A unless you have anything else to add.
Yeah, and I might share just a couple other just kind of big picture recap thoughts, kind of thematic in nature. So I said this early on in the discussion, but I think it is worth kind of replaying. And that is getting back to that efficient frontier. How do we construct portfolios that are optimal in nature, that give you the best return for the level of risk that you're willing to take? That changes throughout time. That study that Harry Markowitz did, that he put together, that used two securities, stocks and bonds, which at the time, that was new thinking back then. Nobody else was really putting what people kind of felt and knew into quantitative terms that could really be made much more scientific, and that really expanded and eventually became the foundation for modern portfolio theory, and is kind of the core coursework for just about anybody that goes to school to learn about how to construct portfolios or how to manage portfolios. And the point in saying all that is that it should and does change throughout time. The answer today is not the same as the answer 5 years ago, not the answer 10 years ago, and today won't be the same answer 5 or 10 years into the future. So it's important that we always have our ears open, our antennas up for what is the current landscape today? What do we see now? What investment opportunities are available to us? What tools do we have to use to really reduce risk in client portfolios or enhance return in client portfolios, or both? Because that really is the name of the game when it comes to investments. Give me that best level of return for the level of risk that I'm willing to take. And alternatives are something that we've seen really expand in their use since the financial crisis, but not going back further than that. I mean, alternatives have been used in institutional type portfolios for a very, very, very long time. I think I read that the first hedge fund itself was created in the 1920s. And so these aren't in concept new ideas, but how they're being used today is, and how they're available to the end investor today is. The things that we can do today weren't available 5, 10, 15 years ago to retail investors, to end investors. In other words, the big endowments that everybody heard, the Yale Endowment Fund, and how successful it was over the years, and the way that they were able to invest was to be able to commit literally millions and millions and millions of dollars to an investment opportunity that might not see any return or any liquidity for a decade, for a very long time, which is something that most investors can't do. But with the use of interval funds and various mutual funds that create much more liquidity and much more levels of access, we have tools that we didn't have access to not that long ago. Certainly when I started with the firm, a lot of these things weren't available to us in the way that they are today. So very excited about alternatives in client portfolios. And I think that in all probability, you're likely to see more, certainly not less, use of alternatives in client portfolios as we move forward. So how that plays out, we'll have to see as time goes on. But just in the last couple of years, we've seen a significant increase in how those tools have been used. So with all that being said, we will go ahead and wrap it up today. We do have a couple of questions that we can speak to. The first of which concerns, I've heard that there are certain requirements for being able to invest in various alternatives. The most common term is the accredited investor. So what do I need to know about that? Yeah, that is true. That certainly is true. There are certain investments that the regulatory agencies have desired to try to protect end investors from committing too much money to an idea when that may put the financial stability of that investor at jeopardy. So they do want to make sure that if you're investing in certain investments, you have the financial wherewithal to be able to make that investment. So you may hear terms like accredited investor or qualified purchaser, and they do have their own different definitions. That is something that we definitely do consider as we're evaluating different investment for client portfolios. and certainly are going to be in a position to recommend those that are appropriate for the given situation for our clients. Cliff, got some other ones here. One is, I just read an article that claimed there are approximately 10,000 public companies with revenue over 100 million, but there are over 90,000 private companies with over 100 million. Kind of getting back to what you were sharing before about there's a lot of them out there. But the point is that there are a lot of private opportunities that aren't all little firms. These aren't all little tiny things out there, kind of your unicorn example here. So I don't know if you have any additional comments to that, other than that does align with what you were sharing.
Yeah, no, those would be global numbers. I was hearing US numbers, but yes, that makes total sense to me. 10,000 versus 90,000 seems pretty close.
I got another question about the specific investments that the brand is using in client portfolios that are under that alternatives category. Some of the ones mentioned here were Principal Diversified Real Asset, the John Hancock Alternative Asset, the Merger Fund. Historically, we've used some other ones besides that we aren't really currently using right now. Those would be on the mutual fund side. Those three examples would be mutual funds that they're daily liquid. We do have some private investments that we've been using as well. Specifically mentioned ones today would be the Stone Ridge Alternative Lending Fund and the private shares. There's another private equity one that we've been using in certain situations called AMD Pantheons. That would be just more of a more down the center type private equity fund. But ultimately, each client situation is different. They're all going to have different allocations, different risk tolerances, different goals that they're trying to achieve. And some or all of those investments may make sense for their specific situation. In some cases, none of those investments may make sense for their specific situation. So it's another one of those good examples where, having that good understanding of that specific client situation is really going to allow us to provide the best recommendations to them. Cliff, here's one that you might be able to answer. Are there publicly traded mutual funds and ETFs that invest in alternatives?
Yeah, and I'll answer that one, and then I'd add to what your last answer is. I would expect we'll see, as Ryan said, more alternative opportunities coming through. We did a little bit in private credit, if you consider that, with the Stone Ridge Fund. We think of it really more as kind of an alternative bond holding, but we'll have probably some other private credit opportunities in private real estate to further diversify. So I think you'll be seeing some more down the road. In terms of publicly traded, yes, as Ryan mentioned, some of the ones we're using are publicly traded. Actually, all of those underlying funds within the John Hancock Fund are actually publicly traded funds or ETFs. So there are quite a variety out there. The previous role, I covered liquid alternatives for a firm, and I'll tell you the number of things that came out after the financial crisis it was incredible. Just the proliferation. Managed futures was the big one that kind of took over right away, because managed futures were up double-digit returns in 2008 when everything else was not. So that was kind of the first one. But yes, there's a wide variety of alternatives available. I think we've chosen to use John Hancock because, as you can see, there's so many different types of strategies out there that you don't know necessarily which one's going to be the one that's going to perform the best over a 3-year period, say. So you want to have diversification there and kind of exposure to multiple types of funds that are out there, be it that managed futures or hedged equity or event-driven type of things. You want to have access and exposure to multiple of them.
Yeah, no, that's a good comment. It also kind of lends itself to one of the challenges inherent with alternatives, and that is, there are literally thousands of funds and investment ideas and ways to access alternatives. So having an appropriate screening process and identifying the handful that makes sense out of the thousands that are available is no small effort. And I'll tip my hat a little bit to Cliff here, and he does a lot of work on his end to try to help us identify. We get together as an investment committee and we talk about different fund additions to client portfolios. And he brings us several ideas that we can talk about. Well, he's whittled that down from, like I said, thousands. It was really a difficult job. And I want to give him the respect that's due there. Certainly, I know he spends a lot of time to ensure that we do really have our attention focused on what we think might be the best available out there. Another question about, and this is a good question. So, as we talk about alternatives, some of them might even have a little bit less liquidity. Do we recommend that type of investment for older clients that potentially could pass away, and have maybe some issue at the estate level? I would say yes, we do recommend it even for older investors. It's kind of one of those funny things I've noticed over the years that everybody likes to say they're old when they get to a certain age. And they, oh, I'm not gonna be around long enough for this to make any sense. And we have that conversation for about another 15 years, 20 years. One, I think in a lot of cases, people have a little bit more runway than sometimes they think they do. But more notably, there are a couple of things that come into play as it relates to, let's just assume for the sake of conversation, this client might have a shorter time frame. I think that creates the need for us to have a conversation, if it hasn't happened already, about how your overall structure is allocated, right? When we're looking at a portfolio's construction, I like to look at it from the highest level. How much do I have in things that grow my assets but have higher levels of risk? And how much do I have in investment types that have much lower levels of risk without the same growth trajectory? And that ratio really, I think, is informed by a number of things, but timeline or life expectancy would be one of them. But a lot of the alternatives that we talk about don't really have that high level of expected volatility. And usually the shorter time frame that we're talking about usually want more of those types of things. So from an allocation perspective, I don't know that older age is really a reason to avoid alternatives. There is also kind of a mechanical issue there where if you've got these investments that have specific liquidity restrictions, I can only sell it 4 times a year, for example. Well, what happens if I pass away? Most of the ones that I've seen do provide a death provision that enables you to get redeemed in the event of death. So, no, to answer that question very directly, I don't see any reason to avoid those types of investments, even for someone that's a little bit older. Another question about liquidity restrictions on private alternatives. Cliff, might let you speak to that one, because I think, like everything else we've talked about today, there's no universal answer there, right? I think it just depends. But if you could maybe share a little bit more about liquidity restrictions on private alternatives.
Yeah, no, I think we've gone about it, at the start of using mostly interval funds, which, may have, some sort of soft lockup where they say you have to stay invested for 12 months or you pay a 2% fee. But they do offer some quarterly liquidity. I think that there's reasons that there's those gates in place. There was a big story of one of the biggest publicly traded, private REITs, publicly traded, but it was with Blackstone. And they allowed a couple of Asian investors to come into the fund. And after the fund was up a lot over 3 years, they said thank you and wanted to withdraw their money. And that's in private real estate where they said, well, sorry, we can't give you all of it because we have a 5% limit, every quarter. So you're going to have to, wait till we can redeem you out. And it was a big story. I think, it was kind of everyone liked to poke at Blackstone because it's this huge fund, and they kind of wanted to see a problem with it. But there's a reason that there's those limitations in place to give them time to, if they needed to sell anything, sell something, but they generally had plenty of liquidity on the sides. Another reason that there's lockups, for like a private equity fund. I was involved with one that we started showing to investors in 2006. That was Carlyle, a big private equity firm. And, so they started investing in 2007. Well, now you hit 2008, and one of the companies that they owned was HD Supply, which ended up writing down 90%. It was a Home Depot spinoff. And fast forward 10 years, they actually made 15% on that investment after they wrote down 90%. But they needed those 10 years to kind of work through all the issues. So there's reasons that there's lockups, reasons that some of these are less liquid, but they do range from daily liquid mutual funds all the way to those longer lockup type of vehicles. But again, we like to have those liquidity gates. We like to have those longer lockups so they're not forced sellers and can actually do what they're supposed to do with the investments and make us money at the end of the day.
Yeah, and that is part of that again, getting back to what I said earlier, if I'm an investor and I'm going to take some additional risk, or in this specific example here, if I'm going to accept some level of illiquidity, I must be compensated with a higher expected return, or nobody will do it. So it's kind of one of that give and take kind of things with some of the more illiquid alternatives is yes, there's less liquidity, but if you can live with that, you can also expect some potentially higher returns. And it gets back to, again, the specific client situation and the overall portfolio size and how many dollars at a given point in time. Are we okay with having those restrictions on liquidity? So it's all part of this story.
I'd say one of the good things about the illiquidity too is that that's part of the reason that you see the volatility is lower, because they're not being forced to move around assets to meet investor demands. Valuations aren't shifting dramatically. They can take their time and not have to make any radical changes. So I think that's another thing that helps with the lowering volatility is just they aren't changing the values of their assets often or as often as things in the public market.
Yeah, which is something we didn't really spend a whole lot of time talking about, but that is part of the volatility story. Certainly, is how often are these things being valued? So you can make the argument that the underlying asset, especially if it's more intrinsically valued, probably doesn't have a lot of change in valuation on a day-to-day or week-to-week or even month-to-month basis. But it's not being valued on a regular basis, so it's just naturally going to have a little bit less volatility than public markets. So it's another one of the interesting aspects of some of the more liquid alternatives. All right, I think we've got time for great question. Great question. One that we wrestle with a little bit internally too. So a lot of times when we're reporting on client portfolios, we're talking about return, but we want to put it into context. So we compare let's say for example, your U.S. large cap blend stock. We're going to compare the performance of your investments to a broadly well recognized underlying index benchmark. In this case, most commonly the S&P 500. Those are easy, readily available benchmarks. Anybody can go look at that anywhere. What do you do with benchmarks for some of the private funds? So Cliff, I'll let you answer that one.
Yeah, that is something we wrestle with, and there is no easy answer. So there's, we can look at that index that we looked at for private equity, a giant big global private equity benchmark, but we don't get that return for at least 3 months later. That's why our numbers were through September, because all the funds haven't reported yet. There's they do take time, so there isn't a great benchmark for private equity. There's not a great one for private debt, and it really depends on what those funds are doing. And so benchmarks are tough. I think we've taken the approach with our private equity of using a blend of small cap and global stocks, which it just is not going to look the same, especially when you get a period like last year, 2022, where stocks are going down, but our private investments are kind of stable to up. Well, that's very different. Or first quarter this year, where stocks are way up and the private equity stuff is kind of still doing the same things, not low type of returns. So there are not great benchmarks for private funds, unfortunately. So I think you kind of need to consider them separately in a lot of cases. On the liquid alternative side, there's some better options. So I think we used one that's called HFRX, which is just they have listed hedge funds that are listed in Europe, so they can get a gauge on kind of what hedge funds broadly are doing on a daily basis. Even that's delayed by a day, so there aren't great benchmarks, but we do our best to kind of compare performance.
Yeah, it is tough, because how do you compare something that's unique, something that's doing something a little bit different than everything else? Which that's one of the great things about alternatives. They have the ability to produce different returns, different ways. But that does kind of create the challenge of, well, how do you compare that to something else? So a lot of times we're left with just evaluating the performance of that investment on its own merit. What is it doing? Is it doing what we thought it would be doing? So it is a little trickier, but again, I think that does it's one of the downs and one of the ups associated with it, because if it was this widely replicated thing like publicly traded stock or publicly traded bonds, it wouldn't have all the advantages that alternatives have. So again, kind of a good and kind of a bad, but at the end of the day, we'll always do our best to evaluate that investment on its merit and put it into the best frame of context that we can.
Yeah, I think it's a great point, Ryan. It's really, is it doing what we expected it to do? And then we should be educating the clients, why we're using it, what we expect it to do, and hopefully it lives up to what we say we expect.
Well, with that, we are just about out of time. I want to thank everybody for the good questions that were asked and for the time again that you devoted to today's discussion. Hopefully you learned a couple of things. There's still a lot of questions to be answered about alternatives just because they are so diverse and broad in nature. But hopefully you come out of this discussion with a little bit better understanding of the main concepts and how we're really using alternatives to try to improve the risk and return parameters for client portfolios. And again, you'll be hearing much more about this going forward. So again, thank you, everybody. Before we sign off, we do want to mention an upcoming event that we have on April 19th. This would be an in-person live event. So for anybody that happens to find themselves in town or that is local, this is going to be an event over at Forest Hills Country Club, which some of you may remember we've done a number of events there over the years. I haven't been one over there in a while, so I'm kind of excited to go back over there. Again, as I haven't been there in a while. But that's going to be Phil Daniels, Tim Eggert, a couple advisors here with Brand, and they're going to be talking about everybody's favorite subject, U.S. debt. It does continue to climb, and everybody wants answers for what's the solution there, what we can do about that. So if you've got the interest and you've got the availability, we would love to see any of you that care to attend over at Forest Hills on April 19th. Please do get registered for that if you'd like to come, because we sure would love to see you. With all that being said, appreciate the time today. That's all we've got for today's session, and we'll look forward to seeing you next time.
Thanks, everyone.